Hey everybody, it's Pete. Welcome. It is Thursday morning, April 7th. Welcome to Stock Trading Pro. Today's Stock Market Live is going to discuss the chaos that you see on your screen right now. The S&P 500 back and forth after the Fed minutes came out yesterday. Looked ugly, looked good, ended up in the same exact place where it started prior to 2 o'clock. And now we have the futures actually rallying. But I want to touch on this picture first. It's one of the most important things. We obviously have a decision to make every time we look to buy stocks. We make that decision of which are the best stocks to buy now. And we do that because we're okay with accepting risk in exchange for where we think stocks are going to go. I spent probably 2 hours yesterday in our private Discord community telling new traders especially that this is not the moment to be excited to be taking risk, because the odds of following through, the odds of having conviction in a trade were very, very small yesterday. And you can see what happened here. So the point that I want to make heading into Thursday, heading into April, really, is you need to only accept risk when you feel like you have a strong edge that you're going to get follow through. And I'm purposely leaving this up on the screen right now just to show you the back and forth. And I'll even give you a couple of other stocks that we were watching yesterday. And you can see here, took off, hit new lows, rally. It wasn't obvious at all. So what I want to walk you through today is we're obviously going to go through the sector rotation. We're going to take a look at the ideas that make the most sense from both a bullish and a bearish suggestion. We do have the best stocks to buy now, and we have a whole group of stocks that we believe are going to get hit the most on the downside. And we're going to talk about that in a second here, with treasury yields turning positive and other stuff that's going to affect what I believe is going to end up being the one sector that's going to get hammered the most. And we'll discuss why as well. If you haven't done so already, make sure you download this. This is a very, very important document to understand right now. And like it says here, you're not going to see this on any major news network. It's actually about following the smart money in and out of stocks. If you know what we do, before we choose to buy any stocks, we track the order flow, and then we read the tape. This document is roughly 12 pages, and it's a roadmap to track the money that flows in and out of various sectors. So when you see me do this every day, and I'm giving the Discord community, the members of our private community, the rotation every day, the very first thing we're looking to do, we do top-down analysis where we start with the market, then we break it down into individual sectors, and we go and try and find the money, find the easier trades, instead of waiting to see what the market's going to do and then reacting after the fact. It's so much easier to get involved when you're just saying, oh, there it is, let's go piggyback. So if you have a minute or two, you'll see this link below this video or in the description. Make sure you get in there and download Smart Money Footprints. It's only 12 pages, but it can be life-changing. And you can see what's in here. Reading the order flow to decide on profit targets. That's the big thing, okay? So obviously we're going to get into what the Fed did yesterday and the conversation here around Fed officials and what happened. The balance sheet is changing. This is nothing new. We talked about this at the end of the last 2 months of 2021, saying quantitative easing is going, interest rates are coming up. The Fed-induced bubble, there's no other way to put it, is gone. You now need to understand how to hedge stocks. You now need to understand when to be in cash or when to be on both sides of the market, where you could be buying stocks, short selling stocks, or even buying inverse ETFs. And I just want to point that out as well for those of you that are new to being involved in the market. When the market is going down, these inverse ETFs, and you can see a little bit better picture, you can see this going up yesterday, and that same time looking at the Qs going down. So the inverse ETFs, so I'm just going to point out which ones they are right now, the SQQQ and the SDS, the NASDAQ and the S&P 500 inverse ETFs, they go up when the market goes down. So if you are concerned about either hedging your existing positions or simply making money as the market goes down and not necessarily wanting to buy put options because you don't like to trade when there's an expiration on the trade, these two, the SDS and the SQQQ, are excellent alternatives to short selling stocks straight out, or if you feel there are none of the best stocks to buy now, this is a good alternative. Okay, definitely something to keep an eye on if you haven't been doing it. So what we want to do now is we want to work our way over into what this means with the Fed. $95 billion a month. It's a huge number, but that's a huge number for ordinary folks like us. It's not a huge number for what they plan to do. It's actually pretty standard. It just sounds like a gigantic number. But what ends up happening here is as they sell what they own, which is what shrinking the balance sheet means, the Fed is actually at the same time increasing rates. So what types of companies will be hurt by interest rates going higher? Now, what they actually said here as well is that they planned to raise aggressively at the last meeting, but did not do that because of the Russia invasion of Ukraine. So now what's going to end up happening is it was 25 basis points instead of what was planned to be 50. Pretty good chance they're going to raise 50. They were very aggressive with their language. That's how the whole thing's unfolding. So now what we need to do is figure out what does that mean from a trading perspective going forward, and which companies would get hurt the most if and when interest rates start to go up in a bigger way. Now, we talked about yesterday, if you happen to watch yesterday's live stream, we talked about home builder stocks getting hammered. They have all been in bearish order flow for a while. You can see here on the charts, they really have not had any kind of relief. Maybe in that one spot, it looked like they're going to break down. But once they fail to form a new order flow in the other direction, there's no reason to buy these stocks. As a matter of fact, they actually broke back down to the downside and started making new lows. So these are on the short side of the market. So we're building the case for what's going to get hurt when interest rates start to rise. And the hottest sector right now by a mile, nothing else is even close at this particular moment. So again, we're following the order flow from Monday, Tuesday, Wednesday, Thursday. So this is heading into Thursday. We're going to get into these ideas right now. So again, if you're not familiar with the home builder sector, with Lennar, Toll Brothers, KBH, and oh gosh, what was the other one? I'm losing my mind right now. The other group, again, getting back into sector rotation. So we're looking at trades on both sides of the market is financial. We talked about these quite a bit. So we've been looking at Morgan Stanley on the short side. We've been looking at Citigroup on the short side. We've been looking at Goldman Sachs on the short side. Now, for buying opportunities, the stocks to buy in the financials, we have actually had a couple of them that have held up relatively well. So if the financial stocks, and specifically the XLF, catches a bid, which right now it's not, but if it does, American Express would be the one that I'd be leaning into. So we're building if-then scenarios, but right now the better ideas are on the short side in this particular group. The bigger picture group that's going to end up getting hit, and they list a couple of them here, Tesla, Amazon, they get a little bit more into NVIDIA on this article in Barron's. These are the stocks, Netflix, that are going to end up getting hurt. And you can see that on our rotation where coming into Monday, technology was the 8th worst, went down to the 9th worst, and they were carrying the market higher, went down to the worst heading into Wednesday, and now heading into Thursday, it's at the bottom again. So that means now we're going to be shifting over into technology stocks as a short sale hedge against the sectors that we are looking to buy. Now, what's interesting is utilities and consumer defensive, they've actually been pretty strong. I generally don't trade utilities, but consumer defensive, consumer staples, depending on how you know it, we've been watching some of these, and they've been slowly grinding higher. We've been watching Pepsi, Costco hit new levels yesterday, Walmart hit new levels yesterday. So what I want to get across here is that while you learn to track first the market, so everything starts with the bigger picture, which is going through the SPY, the Qs, and the diamond. So everybody knows those are the big three. You know, back in the day, you also used the transportation index, but those are the three big indices that everybody should be starting out with top-down analysis when you're looking for stocks to buy, when you're reviewing the stock market. Then you go deeper. Once you have a bias of what the market's doing, then you go deeper into the sector rotation. So basically what we're doing now, consumer defensive, I just gave you a couple of names, but this is the one that's popping out in a monstrous way right now. And I'm going to walk you through a couple of ideas that we were watching yesterday and have been watching for quite a while right now. But I want to make it clear, the technology sector, as interest rates start to go up, is the group that's going to get hit the most. And it's really, what's the word I'm going to it's kind of obvious. Most of those companies are fueling their business growth, or growth stocks in general typically borrow their way until the cash flow and the cash builds itself up. So as interest rates are going to go up, they are going to start to have to pay more to borrow that money. So it's going to be interesting about earnings season now that starts at the end of April, is that will be the first announcements of earnings for stocks and the stock market for 2022. So the guidance going forward is what we're going to be paying attention to, with the increase in what they're going to end up paying for those loans. So it's not a shock that technology is on the short side, that we're going to be looking to short sell technology stocks, if not just straight up use them as a hedge for opportunities to be long. Healthcare is the group of stocks that we're going to be looking to be a buyer of. So some of those, so we'll take a look at the XLV, which is the healthcare sector. And you can see that it's really been in a slow grind move up. Here, we actually are not even close to touching the move. So we pushed and paused, pushed and paused, pushed and paused, pushed and paused, and took off again. We do have some resistance up here, but if we zoom out a little bit deeper onto a bigger picture, you can see here we are literally at all-time highs. So what we want to walk our way through now is some of the ideas in this group that we've been watching. Now, ABBV is one that we've been watching for months, literally since over here. This push and pause and this bullish U-turn is the first one. You can see the nice price action yesterday. Eli Lilly has been pretty strong. You can see the big breakout that Lilly had yesterday as well. So you get the idea of which stocks in this group matter. J&J, another one, okay? We're following and tracking the money. There is absolutely no reason at all to guess what to do next, because it's screaming, here I am, if you do the work on a daily basis like we do. So technology, we're looking for short sales, and healthcare, we're looking for buying opportunities. Now, again, you obviously still need to figure out what your risk reward is. You need to determine where the optimal entry is for you. The only other thing that I want to talk about right now is this group right here, energy stocks, and the opportunity in energy stocks right now. And I'm going to specifically talk about Chevron, CVX. You can see here the chart pattern. Again, it doesn't need to be complicated, but what's happening here is the release of the barrels of oil, the war in the Ukraine. It's created a lot of indecision here, but from a pure tape reading perspective, from a pure trading perspective, we had this massive volatility that just keeps getting tighter and tighter and tighter. And this is not the most complicated trade. It really comes down to, there's only two types of patterns in the stock market that you need to know: consolidation and expansion and volatility. Right now, it's getting tighter and tighter. This price action is just winding and coiling to where the next move out of this is going to be strong. Now, here's the interesting part of this trade setup. We're not calling direction. You would just assume the move is going to be to the upside, and there's a high likelihood of that's going to be, but we're going to let the market tip its head. We're going to let Chevron stock and oil bring that whole thing together for us, but keep this on your radar. The group itself is in the middle of nowhere. They really haven't moved for almost a month, maybe a solid 3 weeks. And you can see all the melted candles here, which represent indecision, versus these energy candlesticks, literally, not figuratively, literally, versus what we're seeing now. So have this group, and specifically CVX stock, on your list for a potential big move that's coming pretty soon. All right. If you have any questions about that, make sure you leave a comment below the video. If you found this stuff helpful, it would mean a lot to me if you can click subscribe, and make sure you hit that like button. Also, make sure you download that PDF Smart Money Footprints. It'll be worth your time. Thanks so much, everybody.